Welcome to Module 2 of reading number 8, very important reading. We've seen the 9 cognitive biases in Module 1. We're now going to look at the 6 emotional biases in Module 2. And do you remember I gave you that mnemonic to remember to help you memorize the emotional biases, all right? Losers. People that get too emotional, they don't tend to win, they tend to be losers. L for loss aversion, O for overconfidence, S for self-control, E for endowment, R for regret, and S for status quo. So that might help you remember those. Then the cognitive ones, there's more of those, there's 9 of those, you don't need to remember them. You can just think, well, if it's not in the losers list, then it must be a cognitive one. And that's, that's where you need to be. Okay, so the L of losers, loss aversion. Yes, we know loss aversion because we've already discussed prospect theory. We know that loss aversion is the psychological trait where we suffer more pain from losing than the joy of winning. Okay, so, here's a client that admits explicitly that they will feel greater pain if their stocks decline than when their stocks go up. Now, here's a very key and important consequence of loss aversion, and that is it tends to lead to us holding on to losing positions too long and selling winners too early. And this goes back to the, where does that come from? Well, it goes back to the value function that is a central part of prospect theory. You might remember that I drew this value function. This is the value of an outcome relative to your returns. So over here you've got gains and over here you've got losses. And this central point here is break even. So you can see by the shape of this curve that this hurts, value goes down a lot faster here than the joy that those gains bring. This is the central conclusion of prospect theory, is that this is how we actually behave. The sting of losing is worse than the bliss of winning. Now, if you think about it, if you do lose some money here, what would you do? Would you crystallize your loss and walk away? Far too painful. Any chance to break even, any chance to get even, okay, you're going to take that. It does mean that you're likely to hold on to your securities for too long. You're likely to view this steep increase in value of breaking even as being desirable, and it would lead you to want to hold on to the security rather than cut it when maybe you should. So you tend to hold on to losers because any chance of breaking even is very valuable to you. But with winners, right above the line here, with these winners, well, look at their profile. Actually, you're risk-seeking down here with losers, aren't you? Because of the convex nature of the value function. Think of the last reading. Up here, you suddenly become risk-averse with gains. So you're going to start thinking, well, I don't want to fall off this cliff, and I haven't got much more upside from a value perspective, so I will sell that one. So you sell your winners, but you don't sell your losers. And that's exactly the opposite of what you should do. There's a saying in the markets, isn't there? Cut your losers and let your winners look after themselves. This is the exact opposite of this. You cut your winners and you let your losers run, which is, hardwired emotionally into the psyche of us in the way that we make decisions, which is what prospect theory states. This problem where we sell winners too early and we hold on to losers too long, this is referred to as the disposition effect. This is the disposition that we have as humans with regards to gains and losses. This kind of disposition did good things for us when we're out hunting for animals and things like that, evolutionary speaking, sort of hundreds of thousands of years ago. But right now it causes us to, in the investment markets, it causes us to sell winners too early, hold on to losers, which is exactly the wrong thing to do. It's called the disposition effect, and we'll define it as that now. I think it's worth doing that now. All right, so disposition effect. So how do you mitigate this? Well, Key thing is keep a disciplined valuation approach. Review the time horizons that you hold stocks for. You know, is there any evidence that you hold losers longer than you hold winners? And also, you know, make sure that you focus on future prospects, regardless of whether you are underwater, you're losing money, or whether you're making money. All right, because that will remove the framing of prospect theory, which is a fundamental part of this loss aversion. Another thing for the exam that you need to keep an eye out for is anybody saying, well, you know, I'll hold on to this, I will sell it when it gets back to my entry price. You know, that is classic loss aversion. Somebody saying, well, I'm going to hold on to this and I'll sell it if it gets back to $12. So why $12? Well, that's where I bought it. Loss aversion. Not rational, just total loss aversion. Okay. Number 2 here, overconfidence. Overconfidence is where we overrate our ability to do things. I'm not saying you're not good at things, but you tend to think you're better at things than you actually are. All right, and you know, this is quite pervasive, more prominent in certain people than others. All right, but it's not that you're not good; it's that you think you're better than you actually are. It's an emotional thing. So overconfidence tends to lead us to think that we can come to conclusions quicker than maybe is practical. All right, maybe we underestimate risk. Maybe we have too much confidence in our calls. We under-diversify and have poor results as accordingly. You know, look at Randy here. Had lunch with his firm's board of directors and then puts 100% of his retirement funds, 401k, into the firm's stock. You know, if that was in the exam, you know, they might sort of bolster that with, you know, based on the brief discussion that he had, or his lunchtime meeting with the board, he's certain that the company's going to do well. They'll kind of top and tail it with a certainty that is not justified by the research that's been done. Another trait of overconfidence actually is getting your confidence intervals for forecasts too narrow, being too exact with your forecasts, too much confidence in your ability to predict what's going to happen. So you'll find that people get their confidence intervals too narrow. If you ask somebody for a 90% confidence interval for where the S&P is going to be next year, you know, if you ask a load of analysts this, then, you know, 90% of the time they should get it right. In other words, the S&P should be in the ranges that they've stated. Rather depressingly, it's only about 40% of the time that the S&P goes on to be in the ranges that they stated were 90% confidence ranges. So they're not as accurate as they thought they were. The other one, of course, just as depressing, is if you ask a bunch of financial market professionals whether they're above average money market managers, you know, investment managers, about 80% of them will say, yes, I am above average, which can only be explained by them over-representing, you know, being overconfident in their abilities. So that's overconfidence. Too much trading, all right, trading on too little information, too much trading, all suggests that you're overconfident. So mitigation here, review winners and losers, don't have too short a time period, have minimum 2-year time horizon, and make sure you acknowledge if you're being too frequent in your trading, and acknowledge, don't just ignore, but acknowledge when you make losing trades. So that's number 2 of 6. Number 3 of 6 is, and this is the emotional ones, don't forget, this is self-control. We did see self-control when we were talking about the savings and consumptions model back in the previous, at the back end of the previous reading. Self-control means you lack the discipline to focus on long-term goals. Short-term gratification, short-term utility, disproportionately, you know, satisfaction, disproportionately outweighs your long-term goals. And that was a key reason why people tended to consume with their current income and not save enough for their future retirement. So we might see an example. There you go. Mark decides to spend his bonus instead of funding his retirement. You know, basic application of a lack of self-control and thinking about maximising utility over all horizons, right? Not just your short-term horizon. So yes, inefficient saving for retirement. Mitigation, try and develop appropriate asset allocation over all time horizons, not just one, but try and maximise utility over all time horizons, which would capture the need for a retirement goal. Okay, the 4th out of 6 emotional bias is the laziness effect, status quo. All right, you just cannot be bothered to consider, all right, the information which might lead you to change your mind. So status quo bias here is just straight up laziness. You don't want to consider new information. You don't want to change your view because that would be too hard work. It's a lot more comfortable to just stick with what you know, stick with what you've got. It's really just trying to avoid the cognitive dissonance and the pain and the hard work of processing new information. All right? So you don't want to make any changes because you can't be bothered to. It's like a form of laziness. The classic application of status quo, it's too hard to think about this stuff. I'll just stick with what I've got. I'm fine. It's that sort of thing. Classic application of status quo is an individual. So in the States, a 401k account is your personal retirement savings. The classic example is where you set your initial asset allocation, maybe when you're sort of 25, 30 years old, and you don't change it. You don't change it and you're 45, 55, 60, and as you approach retirement you should be a lot more conservative in your asset allocation because you've got a lot less time to go. You can't afford, you won't be able to make back losses with a short time frame. You've got a lot lower risk tolerance as you get older. But if you never change your asset allocation, you're just going with what it was at the start. It's just laziness that you don't want to interpret new information and come up with a new asset allocation. So you tend to hold inappropriate portfolios, particularly as you get older as an individual with your retirement plans. The mitigation should be that you should continuously seek knowledge regarding your current position, your current investment objectives. You shouldn't just stick with what you've got because you want to avoid the effort of processing information. Now, very similar to status quo, but not the same thing, it will lead you to stick with what you've got, but for different reasons, is endowment bias. Endowment bias is where you think that your assets are worth more than the average asset simply because you own it. All right, that's endowment bias. So this pen here, this is my pen. It's more special to me than any old pen. And so if I were to sell this pen in the market, I wouldn't sell it for, just the usual pen price in the market. I'd want a little bit more because this is my pen. Me and this pen, So I'm endowing this pen with extra value simply because it's mine. Now the impact of that is to not sell stuff that I've got because people will never, the market price will never really be acceptable. Unless of course there's a big rally or someone gives me a special discount, special conditions. Unless I feel like I'm getting a special deal. We do it all the time when we're buying, right? We want a special deal. Can I get two for... We want it all the time. But when we're selling, it's a similar idea. I want someone to tell me how special this pen is when they buy it. And it might lead me to stick with it if nobody thinks this pen is as special as I do, which of course is the unbiased position. So I feel that an asset is special, more valuable simply because it's mine. Tyler here is refusing to ever sell the stock that his deceased grandfather gave him. Now look, that's okay. It may very well be endowment bias there. It's very special to him. It's been in the family for years. His grandfather gave it to him. So rather irrationally and emotionally, he's refusing to ever sell it unless somebody comes along and pays a huge premium, which reflects how special his grandfather was to him. That is, that's a way of layering emotional, sort of endowing an investment with emotional value that isn't really there. So this could lead you to stick with the things that you've got, which could lead to a non-optimal asset allocation. Mitigation, what you could do is sell things. If you've inherited shares and that's endowed them with value, maybe start chipping away at them at a small amount and start generally diversifying over time rather than selling it all in one go. That might soften the emotional blow to the investor. Okay, the sixth emotional trait here is regret aversion. Don't forget the acronym here is LOSERS, all right, LOSERS, and this is the R of losers, regret aversion. Now, regret aversion generally is where your decisions are made to minimize potential feelings of regret. So generally, you're really thinking here about what could go wrong, and it generally leads to inaction. Regret aversion, the way they present it here, is generally leading to inaction. You don't buy things because they could go down. Things that you hold, don't sell them because they could keep going up, or they could go up, they could recover. All right? This is something that causes you to just, bite on the fingernails and say, I'm not going to do anything. Whatever position you're in, you don't do anything. A classic level 3 question in the morning, which has happened a couple of times over the last 10 years, is to give you to tell you that an investor is exhibiting regret aversion. And they bought a stock and it's gone up. What are they going to do? What are they likely to do? Answer, nothing. Why? Because it could keep going up. All right? A stock goes down. what are they going to do? Nothing. Why not? Because it could recover. That's very different to the loss aversion person, isn't it? All right? Well, I say it's very different, but it is different to the loss aversion person who tends to sell winners, all right, and hold on to losers. So it's the same with losers, but it's not the same with winners. And it's that sort of nuance that if you demonstrate you've understood that from the curriculum and you're applying it to the case in front of you, you'll get the marks, okay? So what do we got here? June can't decide if she should rebalance her portfolio after the abnormal increase in stocks the past 2 years. June is kind of frozen. She doesn't want to do anything. Why? Because she fears what would happen if she did something and it went wrong. What if it keeps going up? All right? This can lead to you to drift into things that are working and long-term underperformance when they stop working. All right? So really the mitigation here is we're going to try and educate the client on the benefits of diversification and, the risks to their long-term goals. Okay, so look, that brings us to the end of the emotional biases. Now don't forget that cognitive biases, issues to do with thinking, we can educate our client and try and remove those cognitive biases, but emotional biases like these, they tend to be hardwired. We can't talk people out of them. They're saying it's just me, I'm overconfident, or it's just me, I'm loss averse or regret averse. And you don't bother trying to talk them out of it. You might point out that they're exhibiting it, but you don't bother to talk them out of it. You actually adapt the asset allocation to incorporate the impact of their bias. And this whole process allows you to better understand your client, which should help you communicate better with your client. It should help you achieve their long-term goals. We know that with cognitive biases, you should try and educate the client to remove them. The word moderate here means remove them. All right? With emotional biases, we can't remove them. No matter how much you tell somebody they're a hothead, they're just like it. It's just me. So we accommodate it, we change the asset allocation. All right? Which is, once again, a very common exam question. You'd have to identify what sort of traits your investor is exhibiting and then suggest whether you try and educate them and moderate the bias or whether you just adapt the asset allocation to accommodate the impact of the bias. Okay? And also, we can integrate some of the things we've learned. Like, remember mental accounting, where we segregate portfolios and have different objectives for different parts of the portfolio. Well, look, that gets a whole name. It's a whole way of approaching building up a portfolio. It was called behavioral portfolio theory in the last reading, but if you employ this as a way of constructing a portfolio in the best way possible so that you genuinely allocate the portfolio to different investor goals and try and meet them with a certain degree of confidence, it's called goals-based investing. And it comes up here, it comes up in asset allocation, it comes up in individual IPS. It's a very important idea, all right? It's consistent with mental accounting, where you're segregating the portfolio. It's also consistent with loss aversion from prospect theory, in so much as you're wanting to protect the safe layer of the portfolio first, and then once you've covered that, you can think about taking more risk. So it's integrating this idea that we're very averse to losing assets that will be used for our most important goals. All right, and it layers the portfolio, segregates the portfolio up, and builds it in layers that are designed to meet different goals. And that was behavioral portfolio theory, really, from the previous section. So we're getting that one, getting this idea for free. It's just a different name for the same thing. If you employ it in your advice, you're engaging in goals-based investing. And we will do that in asset allocation later on. Now, we already know, folks, don't we, that if the biases that your client is exhibiting are cognitive, you should try and educate them and moderate them. And if the biases that your client are exhibiting are emotional, then you don't try and remove them, you adapt the asset allocation for them. But there is another dimension in play here as well. This is your standard of living risk. We really need to consider how our behavioural traits might impact our standard of living. If there's high standard of living risk, there's more requirement that we try and remove them. So whether they're cognitive or emotional, it's very important that we try and remove behavioural biases if there's a real risk to our standard of living. In other words, the behavioural bias could cause us to fail to meet our objectives, to have to sell the house, to not put the kids through college, that sort of thing. Serious risk to our standard of living. So We'll tend to try and educate the client more and remove, that's moderate biases, whether they're cognitive or emotional, when there's a high standard of living risk. All right? So yes, cognitive biases, moderate through education, yeah, but also high SLR, we should try and moderate absolutely, definitely as well. Definitely going to moderate, and if we do that, we should have a high chance, you know, of removing the biases because they're cognitive, and we shouldn't have to adapt our asset allocation, the BMAA, the behaviourally modified asset allocation. It shouldn't be too far away from the traditional finance asset allocation because we've tried to remove these behavioural biases. Now look, if you've got emotional biases and there's a high standard of living risk, you do need to try and educate. Do try and educate, all right, as much as you can. It might not be massively successful, but do try and moderate the biases as much as you can. There might be bigger deviations required from the theoretical optimal portfolio, but do try and educate. Same with cognitive biases where there's a low standard of living risk. You know, do try and educate because they're cognitive, not because of the SLR, but not because of the standard of living risk, but because cognitive biases can be educated away. And when you do that, you know, you don't need to necessarily remove all of them because there's a low standard of living risk. You can, you know, still have a portfolio there that has a slight deviation from the traditional finance optimal weight. But where you must absolutely adapt the asset allocation is where, you know, and not really focus too much on education. You don't have to focus too much on education to remove the behavioural bias, is where they're primarily emotional, so you can't remove them, and there's a low standard of living risk anyway, so the client's got plenty of assets. It's not likely that their standard of living is going to be impaired by their behavioural biases. And there you can hold on to the behavioural biases, don't try and remove them. You can actually have quite a big deviation from the theoretically optimal weight according to traditional finance. All right, so yeah, I mean, this is a table that has yielded marks 2 or 3 times in the last 10 years, so make sure you can spot where a client has particularly high standard of living risk and cognitive biases. You most certainly recommend that you educate, you moderate the effect of those biases through education. It's very important that you do that, all right? Okay, so that's module 2 of reading 8, a very important module. And, you know, make sure you know the losers, LOS, ERS. Make sure you can identify them. Make sure also that you can talk through this graphic here to talk about whether you should adapt or moderate for different types of biases.